Welcome back to the deep dive. It is February 2026, and if you're looking at the
S&P targeting 7,500.
right, exactly 7,500. On the surface, it looks incredible, but uh, when you dig into the sources we have today from Morgan Stanley, J.P. Morgan, and Barron's, the vibe isn't celebration.
No, it's more like vertigo, honestly.
Yeah, vertigo. We're seeing record highs, but the foundation feels incredibly thin.
It's a high wire act for sure. I mean, we are living through a textbook K-shaped expansion. You've got the AI sector just pushing fueled by massive fiscal stimulus, while the rest of the real economy.
It's just flashing red right now.
Yeah, exactly, flashing red. JP Morgan is actually modeling a 35% probability of a recession for later this year. That is a massive disconnect from the stock prices we're seeing.
And a lot of that disconnect seems driven by recent legislation. We have to talk about the text of the OBBBA.
Right, the One Big Beautiful Bill Act.
Passed July 4th, 2025. And just to be clear, we aren't taking any political sides here. We're just looking objectively at the legislative text and how it's distorting capital flows.
Well, it's undeniably the primary catalyst for 2026. The bill effectively front-loaded tax cuts and spending, but it was incredibly targeted. The headline number everyone is watching is the defense budget crossing $1 trillion.
For the first time ever. And our sources point out this isn't just payroll or bureaucracy, it's hard assets. The OBBBA specifically mandates replenishing munitions stockpiles and funding the new Golden Dome missile shield.
Which is why companies like Lockheed Martin and Northrop Grumman are seeing a perfect storm. They aren't just winning contracts, they get immediate tax write-offs for R&D under the new bill.
So they are the clear winners on the upper arm of that K-shaped recovery. But the bill has a sharp edge, too. Looking at the renewable energy section, the physical progress clause looks punishing.
Brutal. To keep their tax credits, developers have to prove significant construction by July 4th, 2026.
Which is only months away now.
Right. It's created this massive supply chain bottleneck that is just crushing margins for green infrastructure even while defense booms. It's a textbook example of policy picking winners and losers.
So defense is flying while renewables are choking. And then you have tech seeing its own split. NVIDIA is, well, at this point, they're effectively taxing the internet.
They're the infrastructure monopoly. 80% market share and 75% gross margins. They're the toll booth for AI. But the more controversial play recently is Amazon.
The market hated their forecast, announcing $200 billion in capex for 2026.
It's an insane amount of capital burn short term. But the analysts we looked at are calling it a structural gain. That money is building AWS data centers and, crucially, robot-filled warehouses.
Which the projections say could save them $10 billion annually by 2030.
Exactly. Short-term pain for a permanent moat, while Alphabet is quietly cutting costs with their custom TPUs.
But playing devil's advocate here, if you are staring at JP Morgan's 35% recession risk, you might not want to put everything into a $200 billion gamble. Where is the safety trade?
You rotate to the boring stuff. Soup, car parts, and gold.
The trading down thesis.
Precisely. Inflation is sticky near 3%. Campbell's is trading at a huge 54% historical discount.
And they offer safety, especially since they pivoted to higher margin snacks. But the favorite in the Barron's report is Genuine Parts Company.
The Napa Auto Parts guys. They're a dividend aristocrat. The logic is simple. When the economy sours, you don't buy a new car.
You fix the old one.
Right. Napa thrives when consumers are squeezed. It's the perfect hedge against tech volatility. Pair that with hard assets like public storage or gold miners like AngloGold Ashanti.
Because they act as a hedge against inflation. So for you listening, the winning strategy for 2026 isn't to pick a side, it's a barbell approach.
Load up on high-growth tech monopolies on one side to capture the AI boom and deep-value defensive stocks, and gold on the other to survive recession risks. You just ignore the middle.
Balance the chaos. One thing stuck with me from the Amazon notes before we wrap up, though.
The sheer scale of the spending.
Yeah, if Amazon is spending $200 billion in a single year just to stay competitive, what does that say about the barriers to entry for literally everyone else?
It suggests the future is a very exclusive club.
Something for you to explore on your own. That's it for this deep dive. Thanks for listening.